If you're a UK company with a US subsidiary, you're about to discover something that keeps finance teams up at night: intercompany accounting. Get this wrong, and you'll face IRS penalties, audit nightmares, and reconciliation headaches that can take months to sort out. I'm Sami Golaski, and I'm going to show you exactly how to track intercompany activity the right way. Intercompany activity is a transaction between your related entities, like when your parent company transfers cash to your US subsidiary, or when you allocate shared expenses like insurance or softwares. There are two main types: cash activities, where money actually moves between the two different bank accounts, and non-cash activities, where you're allocating expenses or income to the correct entity. Common examples include cash transfers to fund operations, shared service allocations for things like IT or management fees, intercompany loans with interest charges, and transfer pricing adjustments. Here's what trips at most companies. Intercompany balances must be perfectly reconciled between both entities. If your UK books show you're owed £100,000 from your US subsidiary, the US books must match that exactly, converted at the US exchange rate. But here's the critical part. These balances cannot sit in your normal accounts receivable and accounts payable balances. They need to have their own dedicated accounts due to US subsidiary or due to parent account. This separation is essential for tax compliances and audit purposes. Everything must also be entered in USD in your US entity books because that's how taxes are filed. We recommend turning on multi-currency functionality at least one of the books so your accounting team can automatically reconcile every month. Let's start with the cash transfers. The most straightforward intercompany activity. When your UK parent sends $50,000 to fund your US subsidiary's operations, both companies record this immediately. The UK parent records a debit to due from US subsidiary and a credit to the cash account. The US subsidiary records a debit to the cash account and a credit to due to UK parent. But be careful, not every cash transfer is automatically allowed. Sometimes it might be an equity investment where the parent doesn't expect repayment. You need to document this intent clearly because this affects both entities' accounts for transactions and impacts tax treatment as well. Non-cash allocations are where things get complex. Say your UK parent pays $10,000 for software that both entities use. You need to allocate this expense based on usage, maybe 60% to the UK, 40% to the US. The UK parent is going to record their portion as an expense, and the rest is an intercompany receivable for the US portion. The US subsidiary records their allocated expense and an intercompany payable to the UK parent. The key is having a documented basis for these allocations. The IRS and UK tax authorities will scrutinize how you split shared expenses, so you need clear allocation methods: headcount, revenue, usage metric, whatever makes most business sense and can be defended. If an intercompany loan balance remains outstanding for extended periods, tax authorities are also going to expect you to charge an arm's length interest rate. This prevents companies from making interest-free loans to subsidiaries in lower tax jurisdictions. Your intercompany agreement should specify when interest rates apply and at what rate. Typically, if balances aren't settled within a year, you'll need to apply a market rate interest monthly, quarterly, or annually. The lending entity records interest income, while the borrowing entity records interest expense. Pricing ensures related party transactions occur at arm's length as well. This might mean adjusting management fees, royalty rates, or service charges to the market rate. For example, if your UK parent charges your US subsidiary $100,000 for management services, but comparable services cost $120,000 in the market, you might need a transfer pricing adjustment. This protects you from a tax authority challenging and ensures proper profit allocations between jurisdictions. Here's how you can stay out of trouble with tax authorities. First, establish a formal intercompany agreement drafted by lawyers that specifies what expenses get shared, allocation methods, and interest rate policies. Second, reconcile intercompany accounts monthly. Don't let discrepancies pile up that you have to uncover at year-end. Third, maintain detailed supporting documentation for every allocation and transfer. Remember, both the IRS and UK tax authorities can audit these transactions. They want to see clear business purposes, market rate pricing, and consistent documentation. Poor intercompany accounting is a red flag that will trigger deeper scrutiny as well. Intercompany accounting doesn't have to be overwhelming when you get the systems right from the start. At Highline, we help you set up proper intercompany frameworks, handle monthly reconciliations, and ensure your documentation meets both US and UK requirements. Want help avoiding intercompany headaches? Get in touch.